Okay, welcome everybody to NCPERS September webinar. This is our Investment Consultants Forum. We've been doing this since the beginning of the year on a semi-annual basis as a way of featuring our investment consultant members. And we've started doing this at the beginning of the year, first just before our annual conference and exhibition. And then now, just before our Financial, Actual, Legislative, and Legal, or Fall Conference. The concept here is to have a conversation with three leading investment consulting firms to get their views on a number of issues, obviously investment related, but other aspects of their consulting business for public sector pension plans. So joining us today are representatives from Asset Consulting Group, Callan, and NEPC. Phineas Troy is the Director and Investment Consultant at Asset Consulting Group. He advises institutional and private clients on investment policy, asset allocation, and manager selection, drawing on prior experience as a principal at Mercer. John Jackson is with Callan, Senior Vice President and Consultant with Callan with more than 30 years of experience in the pension and investment industry. He consults with public and corporate retirement plans on strategic planning, asset allocation, and performance oversight, and co-leads Callan's public defined benefit focus group. Lastly, but not least, Doug Moseley is partner at NEPC, specializing in private equity, credit, and real asset allocations for public funds and other institutional clients. He joined NEPC in 1998 and has since led the client work as well as internal governance and technology initiatives at NEPC. So Phineas, John, Doug, thank you for joining us and welcome everybody.
Thank you.
Thanks, Hank.
Yeah, glad to have everyone here. So we've talked about 6 topic areas that we're going to start with. But we really want this as an opportunity for the audience to engage with these experts as well. So all throughout, we do want to get your questions and comments. We ask you to use the Q&A function on the Zoom platform. And the Q&A can be found by clicking on, if you don't have the screen fully expanded, clicking on the More button, and then Q&A is one of the options that's available. If you have the full screen, it should be one of the functions that you see at the bottom of your screen. So we encourage you to type your questions in there, and we'll get to them near the end of the program. Great. So with that, let's get started. So we're going to talk about, in sort of broad strokes, macroeconomic issues, current events, AI, asset allocation, fixed income, and trustee and board governance. So macroeconomics. Let me start with, I'll just go around the screen as I see it. John, let's start with you. What's broad economic themes should public plans be paying attention to in the next 12 to 18 months?
Well, we continue to see some of the longstanding issues, underfunding, contribution levels, and with respect to asset allocation, certainly the continued efforts to do structure studies and asset liability studies to make sure that the projections are in concert with the expectations of the client. So certainly one of the recent trends has been the reduction in the discount rate from lofty levels pre-GFC to now about 7% of the median level. And what we're seeing from the work that we're doing on the asset liability front is that you have a more synchronized projection in terms of the returns coming from their asset allocation to that of the discount rate, or in the public arena, the assumed actuarial rate of return.
Great. Finney, what are your thoughts? What broad economic themes should public plans be paying attention to?
So thanks, thanks. So certainly, always is in the world we live in is ever evolving and many things to continue to pay attention to. Of course, as we look from a macroeconomic standpoint, talking overall about level of interest rates, corporate profitability, and I say inflation continues to be a key one that we think we continue to have our eyes on and continue to monitor. I think everyone, I'm sure now has read comments from the Fed after their meeting yesterday. As much as there's been some slack in the labor market, there continues to be inflation elevated above the Fed's target there, which certainly will have a tremendous impact on ultimately what happens to the level of interest rates. How low are they kind of able to go? Is it going to continue to keep them elevated? Which, of course, really, as we think about our portfolios, flows into the health of the consumer, how much they're able to purchase, and ultimately impacting corporate profitability. And so a lot of this just uncertainty, around inflation and being able to, if and when, while it has pulled back quite a bit, if it's able to get to that 2% level, it's really led to a lot of the volatility we've seen in the marketplace. Then valuations continue to remain pretty elevated across the board. A lot of expectations and pricing in, and we're going to be able to get this inflation under control, and we'll see if that happens. So certainly that's something, a key theme that we continue to monitor from a macroeconomic standpoint.
Great, thanks, Finney. Doug, I'll throw the question to you, and if you basically concur, then I'll ask you to sort of dive in a little bit more on the inflation, interest rates, and sort of what you took out of the Fed, meetings and the interest rate lowering yesterday.
Sure. I think the key takeaways are that the Fed has, agrees that the market data, while mixed, points to them moving the short rate that they control back towards something more of what a lot of people refer to as a neutral rate, which we think of something that's probably more in line with inflation. So if it's over 4% now, moving it back towards, something that's closer to 3.25, 3.5, depending on who you ask, it could be as low as 3%. And, at the same time, they've got to keep an eye on the inflation data and any, data points that show signs of any further economic weakness, whether it be in, as Finney indicated, the job market, consumer spending has kind of held up. And if the job market numbers continue to deteriorate, I think people will worry as much about the consumer pulling back. And that's something that we're thinking about when we think about, the equity market and where it stands with valuations, because we're back at a level that's very close to kind of where we were at the beginning of the year, both in the concentration risk and also the kind of the high values. I think, looking at the other key problem we see with interest rates is that I think the market sentiment is very focused on what the Fed's going to do with short rates. And long rates have been a little bit mixed in the last 12 to 18 months, where in past signaling from the Fed, you could actually see long rates, start to creep back up. They've come down recently, but they seem to be more prone to being a little bit more volatile. And I think you can tie that to a lot of the uncertainty around things like tariff, federal budget spending, and other economic policies that are in flux right now with the new administration.
Great, thanks, Doug. And John, throwing it back to you, Doug mentioned, the job market as one of the leading indicators. Are there others that you keep a track of, or if phrasing it differently, what are the leading indicators that public plan trustees and staff should be keeping an eye on? Oh, you're on mute.
Certainly the level of interest rates is critical, particularly, as we've done studies for the clients at a higher level. Suddenly fixed income becomes more of a contributor to that 7% target return. So certainly that's something that we pay a lot of attention to. We recognize that, again, fixed income now, rather than being just a diversifier and a ballast to windward, it also is being able to contribute to the return. So that's a big change that's taken place, and it's found its way into the asset allocations as we see more and more clients not only going into illiquids and alternatives like private credit and infrastructure, but also we've had a number of searches in this past year with respect to core fixed income, core plus, as it becomes a little more meaningful in the overall allocation. The challenge is that that are faced by the Fed with maintaining their dual mandate. They're mindful of full employment, concerned about sticky inflation. So, their challenge is how to walk that tightrope with certainly the uncertainty in connection with the governmental policies with respect to tariffs, long-term, short-term. Is it an exercise in negotiation, or is it a long-term plan? So certainly a challenge for the Fed, the Open Market Committee. We saw some dispersion with respect to the dot plot, which was a survey of the opinions of the members of the FOMC. But again, moving towards, potentially two more, median expectation is two more turns before the year end, is certainly an increase from where we were on June 30th.
Great. All right. Are there any other closing thoughts about macroeconomic trends or forecasts? If not, I'd like to start with you, Phineas, on current events. I think John sort of teed it up nicely. When we were talking with, when we were did the investment consultants forum back in the spring, there was a lot of conversations about tariffs. I think that's largely been backed off a little bit, but what are the current events that you see impacting the markets and overall economy?
Certainly. So, and there's always quite a few, right? We always want to talk about this year, this is going to happen, or this is going to happen. I feel like every year there's those conversations. And I think, there's certainly a few going on now, but it's important to remember and kind of put in perspective just how volatile this can cause the markets, right? I mean, we look back at Liberation Day, back in the first, second quarter, we saw the S&P 500, U.S. large cap, which for everyone tuning in, I can imagine is the largest part of all of our portfolios, dropped almost 20% in just a couple of weeks. And we've since seen that rebound back up, up over 30%. I think through the end of August, it's positive 11, 12% year to date. And so, certainly that in itself, can cause quite a bit of volatility. And that cuts both ways, right? There is still a tremendous amount about uncertainty of what will ultimately shake out from all of these tariffs. There's certainly this theme of, it used to be globalization, now pulling back from that, more onshoring kind of in all the different countries. And so from that perspective, really what I think, for all of us as, pension plan, either trustees or staff, there will be winners and losers from a corporate standpoint, right? From a sector standpoint, how does this impact supply chains? And so this is a lot of reasons, certainly a plug for if there's any active managers that are tuning in here, right? How we partner with them to evaluate the opportunity set, continue to expect some of this volatility. Of course, certainly there's a couple different, wars and conflicts going on that, again, everyone we assume will play out and everyone will make nice at some point, but that's also is uncertain. So there'll continue to be some uncertainty there that certainly will bring volatile points to the marketplace, but really ultimately understanding how this impacts the various local economies across the globe and how this impacts the companies who serve those economies that ultimately roll up into our portfolio.
Great, thanks, Finney. So Doug, given what Finney has just said, how do you advise your clients when you have your board meetings, and this question comes up? How do you answer it? And what do you advise? And Doug, you're muted as well.
Thank you. I think the first thing that we say when we think about the level of uncertainty, whether it's economic or political, and the impact that can have on financial markets, is that you need to remain diversified and be disciplined about rebalancing. And we had a moment back in the first quarter, beginning of April, where we had that opportunity to rebalance when there was a sharp sell-off because of, the initial reaction to the tariffs and how quickly that was going to be rolled out. And now we're telling clients that, in the face of the run-up that we've had since April, that's continued into this month, that now is a good time to rebalance. And, we were just talking about fixed income and the role of fixed income. And I think John's points were a good one, is that in the past, we had experienced this low level of interest rates where the fixed income portfolio was really, in place, but seemed to be getting reduced pretty significantly because the low return expectations, but it was still in place because it was perceived as having that counterbalance to equity volatility. We think it still has that counterbalance to equity volatility, but as he indicated, we've got this situation now where we can earn comfortably, 4.5 or 5% from investment grade bonds, and 6.5 or 7 from below investment grade liquid bonds. So I think bonds in the portfolio will continue to play a pretty strong role. Rebalancing in the portfolio, there are a lot of asset classes that are rich right now, including high yield bonds, but keeping that balance, rebalancing by taking some money off the table from equities. And, to the extent that you have a plan that is overweight to its private markets targets, a lot of our clients that have been doing private equity or private credit for more than 10 or 15 years have kind of reached their kind of endpoint with their policy target. They may be overweight. And so, to the extent you're overweight private markets, you could probably cut back on public equities a little bit more. But the last point would be maintaining liquidity. And that's the other thing that fixed income facilitates, is having quality fixed income, whether it's a U.S. Treasury allocation or even U.S. TIPS, will ensure that you can rebalance in the future when we hit more kind of bumpy patches.
Thanks, Doug. And John, you get the last word on current events impacting public plans and their decision making.
Well, similar to Doug, we preach that it's stay the course. The one free lunch is diversification, to make sure that you adhere to your rebalancing policy. Certainly the attractiveness of fixed income certainly helps, given the lofty valuations in the U.S. equity market. You want to take advantage of those rebalancing opportunities. And, it's interesting, a lot of the discussions that we've had in the past years of defending the diversification with international equity certainly has come to the forefront year to date, where we've seen the weakening of the dollar by some 10%, which has been a tailwind for U.S. investors, and kind of justifying that non-U.S. equity role in the portfolio. And if clients were diligent about maintaining that in concert with their strategic allocation, they're certainly seeing the benefits of this year.
Thank you, John. All right, then moving right along, let's talk about AI in investing. And Doug, I'll start with you. So this morning I woke up to a headline saying that NVIDIA is taking a significant stake in Intel, which shows the dominance of AI. And as we all know, AI is the topic du jour at almost every conference. But to the extent that AI meets the investment, where the AI rubber meets the investment road, how are you, utilizing AI in your research and strategies?
Well, great. So we view AI as a theme that is going to impact corporate earnings, whether in the public market or in the private market, and even some outcomes in real assets and infrastructure over the next kind of 3 to 5 year cycle and beyond. Clearly, right now it's the hot topic. It seems to be driving earnings for the public markets this year with several key companies, but it's also driving spending by those companies when they take their earnings and reinvest them into more staffing to meet AI, to offer more products in the AI space, or to get access to more data centers and all those things. I think when you think about it right now, it's similar to the tech telecom bubble that we felt, that we experienced back in 99, 2000, and that it's such a dominant driver of earnings and earnings expectations of the future that you have to, I think, be aware of it, and also think about what are the ways that you can play it that maybe aren't, that everyone else isn't chasing. So certainly in the private markets, in real estate and infrastructure, we've seen more of the managers ramp up strategies. We're seeing the private credit managers lending to those kind of initiatives. And so it's something to be aware of, because all this money that's plowing into it, at some point, that capacity has to get utilized to generate income for these companies that are purchasing either the capacity. And if it doesn't, then that will be kind of a little bit of a potential risk in the future. But right now, I think we're still in kind of maybe the second, third, or maybe the fourth inning of what is a multi-year trend. And when you hear the numbers about what companies like Microsoft, Amazon, Facebook, and others are spending to try to ramp up their capability, we all have to remember that's spending in anticipation of that spend delivering earnings in the future. And we've already seen, many of us, we use the Microsoft suite. We've got depending on whether our IT department has turned it on or not, the Copilot features are available really in all of their suite of products. So they're in a sense, one that a vendor or a potential key winner in this space. But we think the second round will be some of these software companies like SAP or IBM that are working on customized solutions for their clients. In particular, bringing not just the web data that helps these AI tools, but it's their own data integrated with the web data and filtered in a better way to create and solve specific business use cases. And that's something that is exciting for all of us, but you have to kind of look in the private markets and the public markets for opportunities.
Thanks, Doug. John, same question to you.
Yeah, certainly we see it is a little reminiscent of the .com era, where you whisper AI and suddenly the stock price responds dramatically. We've seen some, particularly in the small cap space, where you have increase in the non-revenue companies representing 40% of that index, where again, despite the fact that markets aren't particularly strong, it's these types of non-earning equities that are actually benefiting and being on a speculative nature more so than the quality growth. So, certainly we think it's a positive influence for the future. It's being not only talked about, but integrated. And again, we're pretty early on in the process. In fact, a lot of the managers that they're searching how to implement it into their research front from a consulting perspective. Our application would be more operational use in terms of aggregating data more quickly, more easily. Certainly the resource orientation that it saves resources from us from applying their time to tasks that may be a little more intellectual and looking out a little bit more forward. But again, we're mindful of the fact that it's data integrity that's first and foremost is very important, because as we are going down this highway at 100 miles an hour and assuming that if it's AI generated, there's a certain level of integrity with that data, it's got to be monitored pretty closely, because we've seen certainly some data that may be inaccurate or inconsistent.
Great. Vinny, you get the last word, and let me rephrase the question maybe slightly different for you, which is, as you look at some of the managers in this space, what are some of the really interesting things that that you're seeing, or what are some of the things that that you in your conversations and research have run across that keep you up at night?
Well, first, just on the interesting and exciting part, I mean, there's no doubt that technology is growing exponentially. And really, this, I think Doug made the point, is benefiting so many different types of companies, of sectors, and how all of us do business and how it makes it much more efficient to aggregate data, analyze different things. And so I think, just 2 points out the gate are, first off, all of everyone listening here in our portfolios, we have exposure to AI, and that AI is benefiting the underlying companies where we're invested in really across the board, helping to drive efficiencies. I'd also, echo the point that was made by both, John and Doug. We also have to think about what's being priced into some of these, certainly AI tech focused companies, the multiples, PE levels. There's a lot of excitement around here, but this goes back to the comment that was made earlier around rebalancing. Certainly, again, all of our portfolios have very much benefited from the rise and multiple expansion around excitement around AI, which certainly is true, is driving a lot of efficiencies and success. But it's always certainly important to continue to rebalance our portfolios. But Hank, just to your question around how it's being incorporated, it really is. It's not just, the Googles, the Metas, et cetera, where AI is taking place, but this really is coming to all of our businesses. How we're able to aggregate data, how, particularly from the consultant side, really analyze, evaluate various scenarios, both, looking past and historic situations and modeling out that in the future. So it's certainly, very exciting. Kind of on the risk, though, is certainly so we can have information overload. Right, all of us are getting point to a decision where we have to make a decision and evaluate the data, and still having that kind of human oversight, that conversation, and specifically when it relates to specific plans and unique needs of individual pension plans, making sure we understand what our specific situation, risks, objectives are, and having that conversation. And really, my fear is at some point those conversations aren't had, and it's just based on some analytical data, and again, we need to bring it to the specific of the situation.
All right, great. All right, let's move on to asset allocation strategies. Finney, I'll start with you. How are public funds approaching equity allocation today, domestic versus international?
Sure. So there's no secret to all of us that at least coming into 2025, the U.S., particularly the large cap area, has vastly outperformed international markets. And so what we've seen, hopefully over this time, is a lot of plans rebalancing, pulling some of their allocations, some of those gains from the U.S., adding back to international. This is interesting where we kind of sit here in the middle, I guess, towards the end of 2025. If we look at the broad equity universe, the MSCI Equity Index is kind of the best evaluation of that. It's about 2/3 U.S., 1/3 international from a weight standpoint, right? Like most other indices, this is a market cap weighted index, so where the number of securities don't necessarily change, but the winners get a bigger piece of the overall pie. If you look back historically, and it kind of depends if you look at a 15, a 25, et cetera, but that breakdown tends to be more 50-50, 55-45. And so certainly, as we've been talking with our clients, it's very important to know what the global opportunity set is from a U.S. international breakdown. This is what the market is telling us. Ultimately, these various stock markets are worth, but it's also important to bring valuation into it, and certainly as price multiples if it continue to rise, and we've talked for a lot of reasons about that on the AI side here in the U.S., but being cognizant of those price levels, rich versus cheap. And so we've continued to work with our clients to rebalance into international markets, to ultimately, which certainly has benefited as we sit here today in 25, and at least we've started to see that pendulum swing at least a little bit here in the last few months.
Great. I have other questions, or I have other questions on asset allocation, but we are getting a couple of questions coming in. So I'm going to throw those questions out to the group right now. The first question we got is, should the U.S. still trade at a higher multiples to emerging markets or other developed markets? Who wants to answer that one? Again, the question is, go ahead, Doug.
I can take a shot at it. I think when we think about the U.S. market and the multiples that it trades at, a couple things drive it, right? you know, you can look at the level of growth in the developed markets and in the emerging markets, and the U.S. has experienced higher GDP growth, certainly than Europe over, you know, the most recent history, let's say the trailing seven to 10 years. And so that's part of it. The makeup in terms of sector allocation in the U.S. market is also a driver, right? We've got you know, more big technology companies that operate globally that happen to be based in our U.S. Domiciled, you know, indices. And so think of companies like Microsoft and Amazon and others, Google or Alphabet, Facebook, and they're, you know, they're global companies. They happen to be based in the U.S. The technology weighting in the non-U.S., you know, whether you look at the regional areas like in Europe or look at Japan as in isolation, you see that the technology companies aren't as big a component of the index. And so those are big parts of it. But then certainly the dollar, you know, reserve currency status is something that also we think about when we think about the U.S. markets. It's hard sometimes for us to look at it objectively because it's our home market, right? Our liabilities are based in U.S. dollar. It seems very, you know, logical that we would have more in the U.S. markets. When you look at the MSCI ACWI index, I think, you know, in the last 10 years, the U.S. component of it has gone from somewhere around 50 or just above 50% to closer to 65 or 66%. So you've seen that it's that concentration risk has crept into global markets. And I think, you know, some of the points that that John made about you know, the European markets and rebalancing make a lot of sense. But I think that based on the experience this year, where you saw the dollar weaken versus almost all major groups of currencies and baskets of currencies, that's recovered somewhat. But I think the idea that the dollar will remain that reserve currency kind of at the top of the list is something that I think most investors, and we're recommending that our clients rethink about that a little bit, and what it could look like in the future if other baskets of currencies become bigger parts of the financial infrastructure system, or the way that other global sovereign wealth funds and global central banks manage their currency exposure.
Thanks, Doug. John,
And
Finney? Yeah, go ahead,
I
Finney.
was going to also in that on the premium, and this is particular relative to the emerging world, but also some developed. But you also have to factor in just some, you know, the regulatory oversight that we have here in the U.S. relative to other countries, the political infrastructure. You can kind of make a joke about the political stability, but certainly relative to other regions, you know, this certainly does provide more kind of that safer investment framework, which certainly does justify that additional premium that comes with, you know, interacting U.S. companies, U.S. stock market relative to other places in the world.
Thanks. John, any word from you?
Yeah, I would just add the you know, the exceptionalism that's been experienced in the U.S. markets. If you look over the last 10 years, the Russell 3000 as of June 30th was up almost 13% per annum. Contrast that with the World ex-US, and that was up 665. So again, you're looking almost at a doubling for that U.S. premium, and certainly that's extreme, right? But a certain level of premium, certainly the thought of rule of law, consistency, the decision-making apparatus, that you don't have a conglomeration of a lot of different political entities coming together to have to make economic decisions. Certainly, that warrants a more streamlined approach. So maybe a premium is warranted, but certainly not 2x that we've experienced in the last 10 years.
Great. Thanks, John. All right. Next question. John, I'll start with you and then I'll go around the horn. Please share your opinion on total portfolio approach versus strategic asset allocation. Is TPA advisable for defined benefit plans?
We do not see that approach being adopted by a lot of the clients that we work with. And for the simple reason that this competition for capital in holding out different asset classes have an equal opportunity to access that capital, and the decision-making process, what to overweight, what to underweight, is more of a short-term process. And I guess we would put that, who is going to be making that decision? And when we look at, the differentiating factors in one fund's allocation versus others, certainly no two funds are precisely similar, right? They may have different liability streams that they have to contend with that's going to drive what their asset allocation is. We think that from a strategic or a long-term, it is a little more rigid in terms of once there's a determination what that strategic asset allocation is going to look like, less short-term in nature. So the trustees are making a decision that has kind of a longer-term component, and then the question becomes, for other approaches in terms of asset allocation, who is making that shorter-term decision based on rates, liquidity, and their thoughts about the market?
Vinny?
Yeah, I mean, I think the most important thing, for trustees as we think about setting up our allocation is, and John was saying this, really have an understanding of what do we need from this portfolio? What are the risks? And I think there's certainly, a lot of times we talk about risk like it's just one thing, but there are many different types of risks, right? There's a risk of not earning the return that we need over a long period of time. There's the, typical standard deviation, the volatility, and particularly to the downside, right? Pretty much everyone on here probably is a mature pension plan, meaning we're paying out more each year than we're taking in from contributions. So we need to pull from our portfolio. We can't necessarily afford to do so in big drawdown periods. So what's that max drawdown? And then how liquid do we need the portfolio to be? And kind of really what we found is the best way, once you get an understanding of this, to set up the best, most appropriate portfolio for those needs is through a strategic asset allocation, right? Where you can stress test the various different asset classes, not just in isolation of each other, but how they all work together at that total portfolio level, which is the most important.
Doug, any thoughts?
Yeah, I mean, I think I've heard TPA described in different ways by, some of the state of California plans that have started talking about it versus other large city and state plans that have considered it. I mean, I think the way that we think about it, I think is consistent with both Finney and John's points in that when you think about your portfolio, right, if you started with a clean piece of paper and, $1 billion of assets and you were trying to decide how to deploy it, you're going to look at asset classes as a way to frame the opportunity set and to define what you expect in terms, as Finney said, of risk, return, correlation. How will those asset classes perform? When you think about their expected return, what are the components of it? Is it heavily reliant on income, or is it heavily reliant on, long-term growth and appreciation? And so I've heard, different people describe TPA differently. In one sense, I'm skeptical in that it sounds to me like in some cases, folks are looking for more of a freer rein to where they can classify things and put things in their portfolio. But I think the asset class framework, as both the other panelists mentioned, it ties directly to things like risk management, stress testing, and I'd add evaluating liquidity, right? I mean, I think we've done with our clients liquidity studies, liquidity stress testing. And I think that relies heavily on thinking about asset classes and individual investments and in the framework of liquidity, which is really important. Now, you certainly can incorporate all of that into a TPA approach, but I think, I don't see how you can leave it behind or really de-emphasize it without really potentially taking on some risks that you don't understand.
Great, thank you. All right, another question that came in, allocation to Bitcoin and other cryptocurrencies. Your experience and what are you advising your clients? Finney, I'll start with you.
Sure. So certainly, I mean, this is getting a lot of attention, and I would say still, in our mind, relatively early days with this. Similar to what we were talking about, the overall just AI and technology. I mean, I think what we found is a lot of the technologies that go into place to servicing, mining, Bitcoin, Coinbase, we're seeing these opportunities and these exposures show up in other areas of the portfolio in public markets. So actually, I think, many of our plans do have some ultimate exposure to some of this. The question kind of becomes, as we talk to clients about it, and it goes from the previous question, the strategic asset allocation. If your portfolio is just, everything is competing for capital, where ultimately is the best place that you want to pull out, and add crypto or Coinbase here. And so ultimately we think it's shown to be kind of a volatile return stream still in its early days. So we haven't had many clients fully adopt this, but like we said, a lot of the technology that's going to service some of this, we're finding kind of spill over into other sectors, other areas, other investments, showing up in clients' portfolios.
Doug?
Well, I think I agree. It's early days. I think we're kind of in the, use the baseball analogy again, is like maybe the third or fourth inning. And if you think about the first and second inning where we had, Bitcoin get adoption kind of more on the fringe of the capital markets, then we had, the collapse of one of the big players in crypto, and the kind of soul searching that happened for at least a year or two after that about what some of these firms were actually doing with their platforms for their clients. And now we're kind of entering a new phase where there's more acceptance, and certainly the new regime in the U.S. has really been pushing it, including, with the president's family's own currency. When we go back to fundamentals and basics in investing, what are the drivers here? Are there, earnings? Is there an income stream? It's really about, speculation. And I think maybe the closest comparison might be to gold, but gold also still has value as an industrial metal and as a precious metal in different markets, whereas crypto seems to be driven as a pure speculative asset, with anonymity being part of what it gets tied to. And that, from our standpoint, presents risks to institutional investors that they need to understand. I'd echo what Finney said. A lot of our clients are starting to get some exposure in the public markets through these companies like a Coinbase or others when they go public, or even some of the companies that are buying crypto as part of their capital allocation strategy, including a couple that are, kind of concerning, where you see a few public companies that own north of 50 or $75 billion or more in crypto, and they're borrowing with debt to do that. The question is, how does that model work long term? It's great when they're buying, but if that currency starts to collapse and they've got to service debt by selling the currency, I think there's going to be some strains on that, and you're going to see a lot of volatility. So we don't recommend any of our clients consider it as a separate category. Some clients are looking at angles around blockchain, which probably make more sense in the private markets for opportunities that can be used and adopted in the private sector.
Thanks, Doug. John, anything you want to add?
The only thing I would add is Doug mentioned, the blockchain technology, the foundation. We think that certainly has merit, and we would say it's maybe in the second inning. And there's certainly, whether it's on the private equity front or some component being integrated in some of the public companies, we think that that is certainly an initiative that has merit, that will be around for a while. But in terms of the current applications and your exposure on crypto, too niche, no viable track record to do any risk assessment. And the idea here, what is the earnings thesis that, as we've come out of business schools, it has got to be something more than the last holder theory, and certainly a more fundamental approach to understanding the profit proposition in connection with that investment.
Great. I seem to be having a little computer issue. Can people still hear me?
Yeah, I can hear you.
Okay. All right, great. Sorry. My computer is going a little bit in and out, but I do see that there is another question that was submitted. So this time I'll start with you, Doug. Do you think plans should be increasing their discount rate as CMAs seem to be indicating increases are appropriate?
I think that's the next big conversation for most plans on their, their conversations with their actuary is depending on how aggressive they were lowering their discount rate prior to 2022 when rates really shifted up secularly. If you got down to 7 or below 7%, I think it's pretty clear when you can earn 4.5 or 5 in bonds, and most of the other asset classes on the risk side can earn you well above 7.5, that you can have a conversation about moving your discount rate back up. I think I would also say the other conversation that in some cases is more important from a funding, a funding pathway is some of the plans that have amortization periods that are fixed and kind of putting pressure on the funding contribution each year. And you're seeing those projected to go up significantly in, say, the next 3 to 5 years as that window shortens on the amortization, that those conversations are probably just as important as, some of the plans that have the fixed period that's shrinking. Should they shift to some kind of rolling, 10 or 15 year or even 20-year amortization period, or shift out whatever their end date is if it's driven by a state, mandate, legislative mandate. But certainly, considering a 25 basis point increases, I think is what you're going to see across the public fund space in the next 2 years or so. When you think about state and city budgets, we shouldn't really necessarily have that in our thought process, but the COVID money has kind of wound through a lot of those state budgets that had been sloshing around for a couple of years. If the economy slows down, you're going to see more pressure on the state budgets, and if the plan contributions are growing at rates that are 2 or 3 times what a state total budget grows at, or a city or county, then again, considering that adjustment is responsive to the market environment, and I think what you can get from a plan diversified portfolio, but also probably with reality.
Great. John, and then Finney.
So in terms of response to the current market projections at Callan, we produce a 10-year forecast. We come out with it each year and would say that, the discount rates plateaued at about 8% from 2002 GFC, where at that point in time, it started to come down in recognition that rates have been cut. The projections were coming down, but the discount rates and the assumed actuarial returns had not been coming down at the same level, because to reduce that, suddenly you've got an immediate hit to your funding status, and there was a reluctance to embrace that. So certainly there's an inclination to take an action that's going to create a more favorable funding status, but the fact that to react short term quickly when the opportunity was on the other side of the table, we saw that rates came down to 7%, but you're talking a period of 14 years before that really got from 8% to a 7% level, and the discount rates and the assumed rate of return. So I would submit certainly it's attractive. We've seen, the funding status with not only, the lowering of the discount rate, which was a headwind in the short term, but now we have a greater synchronization and maybe even a more optimistic assumed rate of return with the portfolio than the discount rate. But and we're also seeing that increased contribution. So again, we're seeing a lot of funds not only meeting the actuarial required contributions, but putting in supplementary, because they oftentimes had taken a contribution holiday. And so I guess my thought is, now I saw one survey that was showing the rates, the funded ratios, anywhere from 78 to 82%. In 2007, they were at 92%. So certainly we're not at a point in time where the funded ratios are entirely robust that would warrant not taking advantage of the assumed rate of return for a short period of time.
Thanks, John. Phineas, you get the last word.
Perfect, thanks. So would agreement, certainly I do think this will be a discussion that becomes more popular, certainly led by, higher potential expected returns, really driven by fixed income, right? The yield on the 10-year is about 4%. Typically our managers are able to outperform that. And if we're trying to get somewhere between 6.5% and 7%, if you're getting a lot of that from fixed income, that kind of begs the question. I think we would be a little, hesitant, or at least want to have the conversation before increasing the discount rate. I think a couple of things come into play. As John mentioned, all of us, our consulting firms, put out capital market assumptions going forward. We typically do it over a 10-year period. As those expectations are higher, let's keep in mind just, this really happened post 2022, right? As rates went up and equity valuations went down. We've had really strong returns since then, right? I think if everyone looks at their performance reports, the 1, the 3-year, we've probably front loaded a lot of those strong returns. So it doesn't necessarily mean we're going to continue to get that going forward. And then also just, by the math of, the way the actuaries work with the higher discount rate, certainly it's a better funded status. Potentially, how does that input the contribution levels that might come in? So again, as we think about going forward, what helps grow the plan are the contributions coming in and the returns going forward. And so, listen, I think we're all hopefully optimistic things continue to perform well, but you just want to make sure we certainly understand each plan specific situation. And I'm sure everyone will before making that decision. But I'm sure, as Doug said, this will be a popular conversation going forward.
All right. Okay, we are to the last 8 minutes. So we had a number of questions submitted as people registered. So let me get to those. And again, I will throw it out to the group and just let me know who wants to dive in. One question is, wondering what you feel will be the biggest obstacles for investing in the next 2 to 4 years. Who has some thoughts or comments about this question?
Well, I will say, so a theme that we hit on a little bit, maybe haven't touched about as much, but it just is the increase in alternatives in plans portfolios. And I do think as there are more and more alternative, non-traditional strategies coming to market that all of us have the opportunity to review, I think some of the obstacles are just certainly, first off, understanding what all these various opportunities are. We talked a little bit about crypto, digital assets. Sports investing is becoming, a very, hot topic. So just understanding what those opportunity sets are and really understanding what the liquidity of these investments are. And I think, going back to all of our asset allocation discussions we've had over the past hour, just really getting a sense for all of our specific plans, or how liquid do we need to be over a 1-year period, over a 3-year, over a 5-year, and making sure that, we don't do that in just one fall swoop, but we build up to any illiquid component of our portfolio.
Great. Anyone else? If not, I'll move on to the next question. Why is there such a disconnect between the U.S. stock market and private equity valuations and liquidity? Who wants to tackle this one?
So I'll take a shot at it. We think of the private equity markets as trading when we think of them as a beta, right? So not whether your manager's good or bad or picking great companies, but when you think about the broad private equity markets versus the broad public markets, that the illiquidity premium is really reflected in the fact that the private markets trade at a lower average multiple, right? Now, there's certainly examples in the private markets where companies are marked or trade or are bought at mid-teen multiples, but generally the smaller mid-sized companies that are more actively traded, or even some of the larger companies that are in the buyout space become transaction targets, are generally going to trade for smaller mid-sized companies with shorter histories are going to trade at between 5 to maybe 8 or 10 times earnings. And then in the mid-market and upper market in the private markets, you see that many companies are going to trade, you know, kind of between 10 and maybe 12 times earnings. And different extreme examples, it's higher because the growth rate of the earnings is higher. So generally that difference is just a structural difference between something you can buy and sell regularly intraday on the stock market and something that if you buy into it, you're generally going to have a 3 to 5 year or longer time horizon, sometimes as long as 10 or 12 years. So I think right now, the extreme difference between those kind of two markets, you know, is driven a lot by the technology sector and the growth that it's delivered in earnings and top line growth in the last 3 years. A lot of that, again, driven by changes in technology driven by AI. But we see that, again, over time, there's these patterns that we can observe where that markets and public markets in particular get dislocated. Now, the two markets are linked. So, you know, a lot of private equity exits are through either purchases by public companies or IPOs, which have become probably a little bit less of an avenue in the last 10 years than they were in the prior 15 or 20 years. But that's kind of the way we look at it. There's certainly a lot more money chasing private equity right now, and that's something that we look at in terms of the trends for capital raising and deployment, the uncalled capital and that, you know, dry powder and where that gets and what that can mean for the market and for competition in the private markets. But generally, there's that structural difference just driven by the illiquidity.
And I think if I can just add that, just how I'll say unique, but the last several years have been in terms of just deal volume on the private market side, right? You think about it, you had COVID, which no one knew what to do, so there weren't a lot of transactions. Then you had, you know, certainly kind of right after that, a lot of, you know, money started exchanging hands. But then you had the Fed raise rates 5% in 2022, which certainly put a halt on everything. And then just going back to the beginning of this year, with tariff announcements and how that is going to impact supply chains and everything. So we've seen a lot of starting and stopping in terms of deal flow in the private markets the last few years. I think as Doug is alluding to, that certainly has a big impact ultimately on the valuations within the market, right? With the public market, you can, you know, go sell something on exchange and know what it's worth, but in the private side, you have to have the transactions to know exactly what that value is. And so I think that certainly had a big part of it over the last recent years.
Great, thank you. Next question, John, I'll direct it towards you to start. Active managers are struggling to outperform their passive benchmark indices. Should investors increase passive exposure?
I think that the increase in passive exposure is something that's been going on for some time. We continue to believe that there's certain pockets where active management has got a greater opportunity to succeed. And with respect to the level of concentration, you know, particularly when you're looking at the large cap indices, certainly this has been an area where passive has outperformed or made it very difficult to outperform on the active management front. But you have a great concentration that exists with called the Magnificent Seven. Having an outsized allocation that really some of these positions exceed what a active manager would want to take on. So by doing that, you know, you are enhancing the risk profile, if you will. And I spent a moment talking about the small cap index, and when you look at that, certainly that's a case too, where the more speculative companies are making a greater make up a greater proportion of the index. So, you know, we continue to think that small cap non-US equities are an area where, you know, as we look back historically and look back and look forward, we think it's still an opportunity to provide returns through active management. Great.
Well, we have reached the end of our hour. I want to end by thanking each of our panelists, Doug Moseley, Phineas Troy, and John Jackson, for sharing their wisdom, insight, and knowledge with us today. I want to thank everybody who tuned in today to take advantage of the advice and insights that our panelists shared. And then lastly, I encourage you to join us at our October 7th webinar, where we will discuss our soon-to-be released 2025 Public Pension Compensation Survey. Thank you, everybody, for joining us. Have a great week and a great weekend. Take care, everyone.
Thank you.
Bye-bye.
Take care.